The XYZ company has just acquired a large account. As a result, it needs an additional 75,000 in working capital immediately. It has been determined that there are three feasible sources of funds. One is trade credit. The company buys about 50,000 of material per month on terms of 3 by 30 net 90. Discounts are taken by the company. And two is bank loan. The firm's bank will lend rupees 1 lakh at 13%. A 10% compensating balance will be required, which otherwise would not be maintained by the company. A factor, the third option, a factor will buy the company's receivables rupees 1 lakh per month, which will have a collection period of 60 days. The factor will advance up to 75% of the face value of the receivables at 12% on an annual basis. The factor will also charge a 2% fee on all receivables purchased. It has been estimated that factor services will save the company a credit department expense and a bad debt expenses of 1,500 per month. On the basis of annual percentage cost, which alternative should the company select? So in this problem, the company has three options in front of it. One is trade credit, two is bank loan, and three is factoring. Let's analyze each and every case. So what will happen if the company goes for trade credit? See, if the discounts are not taken, then up to 97,000 can be raised after the second month. So what is the real cost of discounting for this company? The real cost of discounting is 3% on 97, that is 3 on 97, which is for 60 days. Then for 365 days it is 18.81%. So the cost of trade credit for the company is 3% for 60 days on 97. Then for 365 days it is 18.81%. So the next one is cost of bank loan. If the company goes for bank loan, probably it would get 1 lakh, but it has to maintain 10% with them as cash balance, so it would get eventually 90,000. And for that it is going to incur a cost of 13%. So this 13 is the amount payable on 1 lakh, but it is actually the effective cost on 90. So 30 is on 90, so the annual cost is 14.44% if the company goes for bank loan. The third option is factoring. If the company goes for factoring, the factor would purchase 1 lakh receivables per month. So in an annum they will purchase 12 lakhs, but for that they'll have a charge, and of course they'll have a charge which can be processing charges, and there will also be a lending cost. Let's see. So 2% is the cost on the receivables which they buy, which is 1 lakh into 12 months into 2%, which is 24,000. But because of taking factoring, the company can reduce its credit analysis cost, which is 1,500 per month, so 18,000 per annum. So the effective cost of factoring would be 24,000 minus 18,000, which will be 6,000. So the savings affected would be 18,000, giving a net factoring cost of 6,000. But at the same time, the company has to borrow 75,000, right? And that would cost how much? 12% on 75,000. And the company also has to pay the 6,000 additional cost. So the effective cost for this company is 12% on 75,000 plus 6,000. The amount eventually the company gets is 75,000. So the effective cost is 9 plus 6 by 75, which is 15,000 by 75,000, and it is 20%. So what is the conclusion? By comparing the cost of trade credit, cost of bank loan, cost of factoring, the cost of bank loan is the lowest, which is 14.44%. So we'll have it here. The bank borrowing would be the cheapest source of funds for the company.
Thanks for watching this video, and I hope you liked this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click, sign up and enroll. I'll see you inside the course.